There is a major disconnect in Florida real estate right now. On one hand, Amendment 3 could expand Florida's homestead tax exemption to $250,000 for qualifying homeowners. On the other hand, Florida condo reserve laws and property insurance changes are reshaping the cost of owning real estate here in Miami. If you own, buy, or invest in Miami, these Florida housing changes could affect your taxes, insurance, association finances, or future property decisions, but not everyone in the same way. So in this video, I'm separating what already passed, what Florida voters will decide in November, and what these changes could mean for Miami real estate. And my name is Rocky Castro, and I've been helping families buy, sell, and relocate in Miami for over 15 years. Taken together, these could be some of the most consequential changes to hit Florida real estate in more than a decade, because they affect far more than the price of a property. They can change the cost of owning it, the risks attached to it, and who ultimately carries those costs. So if you have any questions about these changes, please feel free to reach out. I am always happy to have conversations and answer any of the questions that you may have. Florida is changing when the true cost of owning property becomes visible and who is responsible for carrying it. For condo owners, deferred expenses are being identified now. Amendment 3 could reduce part of the property tax burden. Insurance indicators may improve without producing the same result for every homeowner. And the Live Local Act is expanding where qualifying housing can be developed now. This isn't a story where Florida property suddenly becomes cheaper or more expensive. It's a story about costs being revealed, shifted, reduced, or redistributed. And nowhere is that more visible than in Miami condos, because a unit that looks affordable online can carry an entirely different price behind the scenes. Imagine two Miami condos listed for exactly the same price. They offer similar space, comparable association fees, and were built around the same time. But the first building has completed its inspections, addressed major repairs, maintained realistic reserves, and can clearly explain its upcoming obligations. The second is still determining how to pay for those repairs. And at this moment, its reserves may be insufficient. The association may be considering a loan, and homeowners could face a special assessment. And those are not financially equivalent properties. And that's what I call the condo's second price. Because you see, the first price is visible, the listing price, mortgage, taxes, and the actual monthly fee that they're paying right now. But the second sits behind the unit, deferred repairs, reserve shortages, association debt, insurance deductibles, and future assessments. And here's the thing, every condominium requires maintenance, and the problem here isn't uncertainty. When obligations are identified, funded, and explained, owners understand what they're carrying. When uncertain, the advertised costs may not reflect the full financial reality. And right now, Florida's reforms are forcing that second price into view. But to understand which building you're looking at, you need to separate two documents that answer completely different questions. The first is the milestone inspection. Its central question is physical. What is the structural condition of this actual building? And here's how this works. A licensed architect or engineer examines it for substantial structural deterioration. And those identified concerns may require an intensive phase 2 inspection. And the second thing you need to know is the structural integrity reserve study. And it's usually called the SIRS for short. Its central question is the financial stability of the building. What should the association reserve for specified major structural components over time? One looks primarily at physical condition. The other looks at long-term funding needs. Completing either document does not mean that the building is repaired or fully funded. The findings and what the association does afterward, that's what matters. A SIRS study may reveal that an association needs more money than it presently has. A milestone inspection may identify repairs that need to take priority over long-term reserve funding. And here's what I see most people get wrong, because this is where the headline about fully funded reserves becomes misleading, because Florida changed the rules again in 2025. Some people describe House Bill 913 as Florida backing away from its condo safety reforms. Others talk as if every association must immediately hold the full projected cost of every future repair in cash. And neither of those descriptions is actually accurate. HB 913 became law in 2025, with most provisions taking effect July 1st of that year. It moved the initial required SIRS deadline from December 31st of 2024 to December 31st of 2025. For associations subject to that requirement. That deadline has passed, although a building's obligations can depend on its height, inspection history, and applicable exceptions. The law also gave certain unit owner controlled associations more flexibility, including potential use of a special assessment, loan, or a line of credit. For certain budgets adopted through 2028, owners may approve temporarily reducing reserve contributions for up to 2 consecutive annual budgets to prioritize repairs recommended by a recent milestone inspection. But that doesn't eliminate reserve requirements. It recognizes that an association may need to pay for urgent repairs while also confronting long-term reserve obligations. So, HB 913 also expanded the review period for many resale condominium purchases from 3 days to 7 days after delivery of required documents. But even under the same law, 2 neighboring buildings can produce completely different financial outcomes. You see, the law establishes the obligation, but the association's history determines where the building starts. One older Miami building may have consistently funded reserves and completed their repairs, but another may have deferred maintenance and now needs an assessment or a loan. And even a responsibly managed building can discover an unexpected problem. And that's the reason why age identifies the questions and it does not give you the answer. Because here's the thing, a well-managed older building may be stronger than a newer building facing defects, litigation, insurance problems, or inadequate planning. Miami-Dade had a recertification program before the statewide framework. Certain covered coastal buildings reach their first milestone at 25 years. Others generally reach it at 30. Local jurisdiction depends on location. So the real dividing line is not simply old versus new. It's whether the building's obligations are visible, funded, explainable, and that changes how we should be interpreting both a low association fee and a high one. Now, the takeaway is not that an older Miami condo is a bad investment or that every building is headed toward an enormous assessment. It's that the listing price and monthly fee don't tell the complete story. A low association fee may look attractive on paper, but it could reflect years of insufficient planning. Compare that to a higher fee, which may reflect an expensive problem, or it may fund realistic reserves, appropriate insurance, and responsible maintenance. Because the better dividing line here is not high cost versus low cost. It's understood cost versus uncertain costs. Florida's condo changes are forcing more cost into the open. And I see it all the time. It can be painful for owners today, but hidden structural and financial obligations carry their own risk. And that creates the first half of Florida's contradiction. Condo policy is making some ownership costs more visible, just as Florida voters are being asked to reduce a completely different carrying cost. This may become the biggest Florida property tax headline of 2026. Florida owners could receive a homestead exemption of up to $250,000. And look, that number, it's real, but without the conditions attached, the headline can be a little misleading. The change has not even taken effect yet. The legislature placed Amendment 3 on the November 2026 ballot. But in Florida, in order for it to pass, it needs at least 60% voter approval to get through, and if approved, would take effect January 1st of 2027. So Florida owners shouldn't calculate their finances as though the expanded exemption already exists. And even if voters approve it, there's 3 questions that determine the result and who actually qualifies for it, which taxes it would affect, and when the full amount would become available. The first surprise is that 2 Florida homeowners with similar properties could receive different exemptions based on when they established permanent residence. Amendment 3 creates an important dividing line around January 1st, 2027. Under the new proposal, people who maintain permanent Florida residence as of December 31st of 2026 and who have established or will establish a qualifying homestead could receive an exemption from non-school property taxes of up to $150,000 beginning in 2028. That exemption could reach $250,000 with positive inflation adjustments beginning in 2029. People maintaining Florida residence on or before January 1st of 2027 would start under a different schedule. They would initially receive an exemption of up to $50,000 from non-school taxes and generally become eligible for the larger exemption beginning with the 5th year of residency. This matters in Miami-Dade, where one property may be a primary residence, another a second home, and another owned by someone planning to establish Florida residency a little later. But here's something to note. Owning property before the cutoff is not necessarily the same as maintaining permanent residence or a qualifying homestead. Those are specific eligibility questions. And residency timing is only the first limitation. Even someone qualifying for the full exemption would not receive a $250,000 reduction across every portion of the tax bill. When someone hears a $250,000 homestead exemption, it's easy to assume that amount would be removed from the taxable value used for every line on the bill. That's not what Amendment 3 proposes. The expanded exemption would apply to non-school ad valorem taxes. So how it would work is that it could reduce the taxable value used by certain county, municipal, and other non-school levies, but it would not apply the same expanded exemption to school district taxes. And that's exactly why we shouldn't describe Amendment 3 as eliminating property taxes or assume two qualifying homeowners would save the same amount. The actual savings would depend on assessed value, taxing authorities, millage rates, and eligibility. As an example, a City of Miami owner may therefore see a different dollar result from an owner in unincorporated Miami-Dade. Market value, assessed value, taxable value, and the final tax bill are related, but they are not interchangeable. And while the homesteaded owners focus on the potential of a $250,000 exemption, investors and second homeowners are watching another number inside the same amendment, and that's 5%. Amendment 3 also proposes reducing the annual assessment increase cap on specified non-homestead residential and non-residential property from 10% to 5%. Depending on the property and its status, that category can include rentals, second homes, commercial real estate, and other property that does not qualify as the owner's homestead. For Miami investors and second homeowners, this may be more relevant than expanded homestead exemption. But like most of these bills, the wording here, it actually matters. This would cap the annual increase in assessed value for covered non-homesteaded properties. It wouldn't cap the tax rate, freeze the total tax bill, or guarantee that an owner pays less than the year before. The final bill here can still move if applicable millage rates or another part of the property's tax treatment starts to change. The proposed cap could create greater predictability, but the benefit depends on the property's value, history, and tax status. The correct outcome here depends less on the headline and more on which ownership category you actually occupy. The simplest way to understand Amendment 3 is to ask 4 questions. Does it receive the 60% voter approval required to pass? Voting is on November 3rd, so make sure you get out there and vote the way that you feel is right. Is the property homesteaded or non-homesteaded? And when did or when will the owner establish qualifying permanent Florida residence? And the last question is which portions of the tax bill would receive the proposed tax exemption? Until those questions are answered, the $250,000 headline doesn't tell us the individual result. And that's because this is not a universal property tax reduction. It would simply distribute protections differently among residency and ownership categories. So if this breakdown is helping you understand what is actually changing in Florida real estate, please go ahead and subscribe to this channel. I cover the Miami market without the hype and explain what these headlines means for the people who own, buy, sell, or plan to actually move here. Now, let's talk about insurance, because this is where improving statewide headlines can look completely different at the property level. Florida's property tax insurance market presents another disconnect. State regulators and insurance officials say conditions are stabilizing. More insurers have entered or expanded in Florida. Citizens has moved policies into the private market, and more rate filings are requesting decreases or no change at all. But many owners look at the renewal and ask, if the market is improving, why am I not seeing meaningful relief? And that is because both of these experiences can be true at the same time. Market stabilization describes the broader system. Affordability describes what an individual owner pays. And the thing to understand here is that a market can become healthier without becoming inexpensive. And think about it like this: improvements in statewide data may take time to reach individual renewals, or may not reach every property in the same way. And to understand why, we need to separate 3 numbers that are often reported as though they mean the same thing. The first number is the rate change and insurer requests from Florida regulators. That filing is not the final result. The second is what OIR approves. An approved average decrease does not mean every policyholder receives that exact decrease. The third number is the individual renewal premium, and that result can depend on the property, the coverage, deductibles, replacement costs, mitigation, and claims history. This is why a carrier could receive approval for an average reduction while a particular Miami owner still sees an increase on their insurance premium. OIR reported that for residential policies effective in 2024 or later, dozens of insurers had requested decrease or no rate change. That is encouraging as a market indicator, but it does not mean premiums are falling for everyone. So whenever you hear about a rate headline, ask whether the number is requested, approved, or reflected in an actual renewal. And here's the thing, Citizens policyholders face another layer to this because the most important change may not be a percentage. It may be an offer to leave Citizens. Citizens Property Insurance Corporation is Florida's state-backed insurer of last resort. Its depopulation program moves eligible policies from Citizens to private insurers approved to participate by the Office of Insurance and Regulation. Citizens reported transferring more than 546,000 policies during 2025, and depopulation has continued throughout 2026. For the individual policyholder, however, the important question is what the private market offer means for your actual property. And here's what most don't understand. A lower premium is definitely attractive, but price is only part of that comparison. Because here's where you gotta look deeper. Coverage forms, hurricane or wind deductibles, limits, exclusions, endorsements, and loss settlement provisions that may actually differ. And look, that does not mean that a private offer is automatically worse or that remaining with Citizens is automatically better. It simply means that two policies with similar prices can transfer different amounts of financial risk back to the homeowner. And available choices depend on the current rules and actual offer, which should be reviewed with a licensed insurance professional. And even neighboring Miami properties can receive very different insurance outcomes. Insurance is not pricing the Miami housing market as one uniform category. The things that matter here, construction, roof condition, wind mitigation, replacement costs, claims, coverage, deductibles, and coastal exposure can all affect the outcome. Condominium insurance, it adds a completely different layer because the association typically carries a master policy while the unit owner carries separate coverage, but both costs converge on the owner. If the master premium rises or the building carries a large deductible, the effect may reach owners through fees or actual assessments. And the unit policy is another cost altogether. A statewide average just simply cannot capture those building level and unit level differences. Miami-Dade's coastal exposure, expensive construction, older buildings, and condominium concentration can also produce outcomes that look different from other parts of Florida. And this is why the market is improving and my property is still expensive to insure aren't contradictory statements. When you see the next Florida property insurance headline, ask yourself these three questions. Is this a requested rate, an approved rate, or an individual renewal? Is that number statewide, countywide, carrier specific, or policy specific? And did the coverage change along with the price? Those questions tell us whether the headline describes the market, the insurer, or the owner's actual result. Because Florida's market can become healthier without becoming affordable. Citizens can shrink while individual Miami properties remain expensive or difficult to insure. And the condo laws reveal more of a building's structural and financial cost. Amendment 3 could change part of the tax burden. Insurance prices, the risk of the individual property. But Florida is also trying to change the housing cost equation from the supply side by expanding where qualifying housing can honestly be built. Imagine a commercial property where the local government might previously have rejected a large apartment development or required a traditional rezoning. If that property and project qualify under Florida's Live Local Act, the state may require the local government to authorize the residential use administratively. And that represents a major shift in who controls certain housing decisions. Florida enacted Live Local in 2023. For qualifying rental developments in specified commercial, industrial, or mixed-use areas, the law limits local government's ability to reject residential use. But Live Local is often described as either a small development incentive or a law allowing apartments anywhere in Florida. And look, neither of those descriptions, in my honest opinion, are actually accurate. How I see it, most of the law's meaning sits inside of 5 words if the proposed project actually qualifies. Live Local isn't a blanket authorization to build apartments on every parcel around Florida. A project must satisfy requirements involving the property, rental use, and affordability. So as the law is written, generally, at least 40% of its units must remain affordable for at least 30 years. The property must also fall within an eligible category. And here's the thing, projects must still comply with applicable building, safety, permitting, and non-preempted development standards. And there is certain areas that still remain excluded. So Live Local just doesn't remove local government from development review. It just changes which decisions local governments may make when a project satisfies the state's conditions. And Florida expanded that framework again in 2026. House Bill 1389 took effect July 1st of 2026. The law extended live local preemption to qualifying government property and certain religious institution properties larger than 3 acres that have contained a house of worship for at least 10 years. It also addressed parcel assemblages, restricted the use of setbacks or stepbacks to defeat authorized height, clarified exclusions, and changed parts of the missing middle exemption for 2027. Florida didn't simply create a subsidy. It changed the legal leverage available to qualifying developments. In Miami-Dade, the question is where those projects could realistically appear and whether they can actually be built. Live Local can expand housing possibilities on eligible commercial corridors, government-owned property, certain religious institution sites, and other qualifying locations. Miami-Dade publishes guidance and project information, giving us better evidence than speculation about which neighborhood may actually change. But legal eligibility does not make a project inevitable. A development still needs land, financing, permits, infrastructure, and a workable construction budget. Site constraints and required affordable units affect feasibility. That's why we shouldn't promise that Live Local will suddenly make Miami more affordable, because more eligible sites don't automatically produce completed housing. Live Local can open the door to development, but it cannot guarantee that a project can't afford to walk through it. And the simplest interpretation is this: Live Local is more consequential than a traditional tax incentive, but more limited than statewide blanket rezoning. For qualifying rental housing projects, Florida has transferred part of the land use decision from counties and municipalities to the state framework. Its effects will depend on the projects actually proposed, financed, and completed. And now we have 4 changes affecting 4 different parts of Florida housing: building condition and association finances, property taxes, insurance risk, and future housing supply. The final question in all of this is, who feels the change and which Miami properties may be in the strongest position as these responsibilities shift? Because the truth is that there is no universal outcome for the Florida homeowner. Condo owners may feel repairs, reserves, and insurance. Homesteaded owners may focus on Amendment 3, while investors may care more about the proposed 5% cap. Citizens policyholders face private offers, and renters may eventually see Live Local affect supply. Those same changes can create relief for one person and added responsibility for another. So the new dividing line in Miami real estate is not simply old versus new, condo versus single family, or expensive versus affordable. It's understood cost versus uncertain costs. A property may still be expensive, but when its structural condition, finances, insurance, taxes, and obligations are explainable, the owner understands what they're carrying, because uncertainty creates a different kind of risk. And that's the common thread connecting this video, because Florida isn't uniformly making real estate cheaper or more expensive. It's simply changing when the costs become visible, who is responsible for them, which owners may receive relief, and which risks remain attached to the property. And no single Florida housing headline explains that clearly. So you don't need to memorize every single bill number. Instead, ask yourself these questions whenever you hear about a Florida housing change. Has it passed? Is it still proposed? Or is it only a market indicator? Also ask yourself, which type of property and owner does it honestly affect? And is the consequence immediate, or does it depend on a future vote, renewal, application, or honest development? And lastly, what does the change mean specifically for me here in Miami-Dade? And those 4 questions will always tell you far more than the headlines. Taxes, insurance, association costs, and the everyday cost of living can combine very differently depending on where and how you live in Miami. So watch this video next, where I break down the real cost of living in Miami in 2026 and the expenses people usually underestimate before making a move. And I want to thank you for watching, and I'll see you in the next one.